Good morning, everyone. Your investment advisor Bill here. Let's look at a recap of how the market did for the week of April 12th. I'm going to share my screen with you. You can see over here that I'm calling this presentation the Thelma and Louise Market. Now, the Thelma and Louise was a very popular movie where two friends find themselves outrunning the police, and at the end of the movie, in this incredible climactic ending, they're cornered at the edge of the Grand Canyon after a cross-country chase away from the law. And of course, rather than surrendering, and face imprisonment, they just decide to make this super bold choice of choosing freedom over captivity, and they drive their car off the cliff. But there's a few things about the market that we have to understand is very different, even though it feels like Thelma and Louise Market was very different than the actual movie. And that is, we don't ever just drive the car off the cliff. We always change and we turn around and we correct, right? We just don't go straight off the cliff. So a stock market panic needs two things. A panic needs, we have to be experiencing some kind of national or preferably a global financial economic trend or event which nobody can possibly understand, causing fear and confusion and uncertainty and unrest, uneasiness. And the second thing it needs is that the masses, the group of people, the globe, must conclude that this crisis can never be solved. Nothing can stop it from incinerating the economy, causing them to say, this time is different. And people are saying it all over social media. All my friends, all my family are saying, this time it's different under Trump. He is going to drive the car off the cliff of the market. But as you can see, we've had a 90-day hold on tariffs that happened this week. And we also had some exemptions coming out after the close on Friday, where Apple Computer, NVIDIA, all the semiconductor chip makers are all getting exemptions from the tariffs. And so the market, I think, is anticipating that. When it heard the news on Friday, the market rallied over the weekend, like on the after hour market. So things are already beginning to improve. And so here's a daily chart of the S&P 500. We can see here that we had this massive panic over here. This actually was kind of caused by some news coming out in the beginning of the year on the Chinese version of artificial intelligence called DeepSeek. It was really then that they just pulled the plug on the market because it was considered that their technology was 50, 60, 70% less than the AI technology that we were creating. And therefore, NVIDIA and Facebook, Meta, and other companies just took it, the sell-off began at that time period when that news came out. But I think we capitulated this week with this market low over here. And we're going to go with that for now. But the market had experienced a tremendous decline since the beginning of March, I'd say. And so here find ourselves at the third highest panic level on record, at least in the last 25 years. So during the COVID crisis, the market got to be 185% oversold. 185% oversold. During the dot-com bubble burst, it reached a negative reading of 144%. During the Great Recession of 2008, 2009, the global crisis, the depression that was announced, we only reached a negative 100% oversold in the market. And here we are during the tariff issue. We reached a reading of a negative 134%. I find that really interesting and definitely an extreme position. And what it's like is like if you take a ball in a swimming pool and you hold it down underwater and then you let go of the ball, it just shoots up to the top. That's kind of what we saw with the market this week. And you'd be surprised to find out that the market was actually up this week. The NASDAQ QQQ, the high technology indexes, was up 7.5% this week. The S&P 500 up 5.7, the Russell 2000, which I call Main Street because it consists of companies that are publicly traded, but you probably drive right past them every single day and you don't even notice, right? They're not the companies like Walmart or Facebook and gargantuan companies that you notice. Now, Bitcoin was basically unchanged for the week, and short-term or intermediate-term bonds were down 2.68. So bonds yields increased a little bit. And once again, I think also part of the problem, part of the panic, was this revision in earnings in the first quarter. Now we saw the first quarter earnings announcements and estimates come down lower. The market sold off, but expectations going forward are still higher for the rest of the year. So I think this was a great time to buy a panic that was understandable but temporary. And I think we're going to do pretty well going into the rest of the year. Here we have a 30-year conventional mortgage. Interest rates went up a little bit on the 30-year mortgage. Again, this is just the back end, the far end of the yield curve, they call it, where was up slightly on the week. And um, let's just see how this goes. Clearly, the trend is down going back from 2023 when interest rates reached their peak. Inflation reached its peak conversation. So this orange line kind of shows that the trend is down in interest rates. And I suspect we're going to kind of settle in between this 4.5% and 5% in mortgages going forward. So at least that's for the time being. Again, these kind of stock market sell-offs we get every 16 months. And here we are. Last one, 16 months ago, right on schedule. So again, I think the sell-off was maybe greater than we saw a year ago, 16 months ago. But once again, we're probably going to snap back up to this 200-day moving average, which puts the S&P 500 up in the 5,700 area, would be a great rally from here. Here we have the 10-week moving average. Again, this measure of volatility away from uh, its standard deviation, or like how far away from the middle of the bell curve. If you have a pendulum of a clock, like a pendulum clock, how far are we overbought or oversold depending on when we swing, and we can expect to go back to the other side. Here we have the 2020 COVID crisis. We had the 2022 bear market that nobody ever talks about. I mean, Facebook shares of Facebook went from 360 to 75 or 80. Coinbase went from 350 to 45. Moderna went from 500 to 27. So once again, these interest rate rallies in interest rates from a 0 to 5.25 crushed the stock market. But that's not where we're at now. We're actually in a interest rate declining. This is where liquidity is coming back onto the market. This is very positive. So you have to be more aggressive in buying this stock market sell-offs when the interest rates are again at our back and pushing us forward, and we hit the wind at our sails, which is really a good thing. And here I just want to bring to your attention a very long chart going back to 2005, 2006 of continuous corn. Why do I bring a corn chart into this presentation? Well, because corn is in everything. High fructose corn syrup, it's in our sweeteners and our drinks. It's what we feed our cattle and our pigs and our chickens with, and everything under the sun. So you can see that there's only one thing more volatile than Bitcoin, and that's the price of corn, depending on whether it's a drought or we have a high carryover. But again, corn reached 7.80 to $8 a bushel back in 2009 and 2012 and 13. Hit a complete crush down to the 200 and low 200 price for corn, which really I didn't realize we got down that low in this time period. But once again, we're kind of in the low end of the range, around $4.80 a bushel for corn. What does this mean? Well, I think that we were afraid that perhaps the tariffs might affect our exporting of grain and corn around the world. But truthfully, I don't think that we're going to have that problem. I think we're going to get exemptions from farmers. Um, Inflation is coming down, so I don't think we're going to see inflation-based food prices higher. I think we're going to settle in between this 350 and 450 area for corn. And I'm kind of positive about food prices and inflation. Recent inflation, as measured by Trueflation, is 1.35%, down from 9% a few years ago. So I'm really very optimistic about gas prices coming down, food prices coming down, rent coming down, and all the things that are our expenses coming down in value. So once again, I think that things are looking pretty good. And the market, I believe, has put in a short-term bottom for the next year, maybe 8 to 12 months. And we're just going to take it one day at a time. So thank you so much for your continued trust. Feel free to give the link to this video to any of your family or friend members. And have a great weekend. And we'll be in touch next week. Thank you.